Hello, everyone. Happy Friday. It's time to roll the sleeves up. I started the week off with an audio piece and that transcript. If you had the chance to listen to it or read the transcript, of course, the transcript's going to read a little odd because it's verbal. But the premise of that was let's get some thoughts in front of you first thing this week because the volatility really ramped up on Tuesday. Surprisingly, Monday was a very calm day, eerily calm, and I think that maybe have with hindsight, of course, that kind of should have been maybe a what's going on here, but of course, part of the reason that Monday was so calm was because we've seen these kinds of events happening over the course of the past I don't know how many years should we say, right? It's not just in the Middle East, right? We've seen issues Ukraine and Russia. We've seen, of course, we could really go back to the early 2000s, but in our modern context, we've seen these kind of one and done missions, right? And for that reason, I think a lot of people were of the mind that that's what this is. This is a one and done mission. This is like a Venezuela thing, or this is like, remember last year when we supposedly took out all the Iranian missiles and nuclear capacities or whatever. But that was kind of last year's thing, right? Oh, we bunker buster, boom, 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 everything's done. And then it supposedly wasn't. Not here to comment on that, right? I'm not taking a side in this right now. There's not enough information to take a side. There's speculative information and there's historical context, but what I want to do today is very quickly, I'm going to try to watch my time. I say very quickly, and sometimes those go on way too long. But very quickly, I want to take you through kind of a chart chat. I'm going to call it that. It's a terrible name, but it is what it is. I'm going to visually take you through some broad indexes to show you what I meant on Tuesday when I said so far the selling is very orderly. Now, granted, I am recording this before the market opens on Friday because I want to have this in your hands as you go into the weekend. I don't want anything to be stirring inside you. I want to be able to maybe put some fears at ease. But that being said, I also want to bring to your attention the things that I'm watching so closely so that you understand that there is and is not a reason, right? We have a very, very clear discipline in how we manage our investments. Having that allows for weeks like this where I'm not going to lie, this week's, forgive my way of framing, but it sucked. It sucks for me because at the end of the day, even if I have all the signals in the world, I don't have to listen to them. I do. I don't have to because inside I have the same internal turmoil that you do, right? I'm looking at this and I have opinions on what's going on. I certainly do. But I bring that to mind because I have to know why and when I'm taking action so that internal that internal turmoil doesn't take the wheel and start making decisions because that's when irrational bad decision making happens, and that goes for investments, it goes for financial planning, it goes for making life decisions. A lot of people, you got to be really careful. Don't let that gut thing get in the way of the plan that you've charted the course for. The plan intentionally integrates this kind of stuff. You plan for these kinds of fluke or not fluke, depending on how you look at it, but these anomalous or not anomalous, I hate to be redundant in that way, but these kinds of things that are not just butterflies and rainbows and happy, 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 right? The uncertainty. The trick though is having that plan and having that course of action in place. Stick to it. Now is not the time to deviate. But anyway, I'm going to run through this 5-minute intro. I'm going to try and bang through some of these charts just so that you can see visually, because again, that's what charts are. They're visual representations of sentiment, visual representations of where the market agrees fair pricing should or shouldn't be. Sometimes it's not the market, sometimes it's manipulation, which we're seeing in the metals market right now. And that is very unfortunate. But without further ado, let me get into these charts and then we'll walk through case by case and kind of build our way to the evidence approach. And again, I want you to go into the weekend with a sense of okay, I understand kind of what's going on. If you don't, call me. We need to talk. I don't want you to have those feelings. My job is so that you sleep well at night. Um, and if you're not doing that, if this is causing concern for you, it's just a lack of information. So let me be the one that can provide you with the information you need to satiate that little voice in your head that's very unsure, very uncertain, or whatever it might be. I can't satiate the uncertainties about global economic or geopolitical affairs or those kinds of things. I can satiate what is actually impacting you directly. So here we go. Let's get into the charts. All right, let's dive into it. First chart I'm bringing up here is the S&P 500. This matters, right? I am recording before market open. As of right now, our pre-market futures are down about 1% on the S&P 500, about 1.25% on the Nasdaq 100. So, are we going to have a negative day? I actually am not. I'm. I'm. I'm of the mind if I were forced to be a trader, which I'm not going to be, but I think we're probably going to close the day either break even or maybe a little bit up today. We'll see. But with that being said, it is Friday the 6th. In case I didn't mention that earlier, but here's what we're looking at. We have very clear resistance and we have very clear support. 65.42, roughly speaking, and I'm using basically a closing low here, and then the resistance at about 7,000. Where did I get those numbers from? Well, those numbers are derived from multiple sources. We are building the way to the evidence, but the reality here is I can take extensions of the trends dating back here to April of 25, going up to October of 25, and then the selling that we saw at the end of last year. And there was some big selling, right? We see these two really, really large sticks. Those are intraday sells that took us down quite a bit, came down coincidentally to this support level. We'll get to that in a moment. But if I took just this smaller trend, right, the trend of 2025, and I were to extend it forward using Fibonacci numbers, which just to quickly remind you, the Fibonacci sequence, it is sacred geometry. It is natural geometry. If you were to say, Mother Nature, teach me math, this is the lesson Mother Nature would teach you. Not only has she spread it amongst the flora and fauna in so many different ways, from the nautilus shell to the dandelion flower to whatever else you might pick, we as collective humans, even if we're the ones that design algorithms, even if we're the ones that design calculations and algo trading and all this futures and derivatives and all those fun options, blah 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 blah. Okay, still created by humans. For that reason, the market is very natural. I know it sounds crazy and a little crunchy to say. I don't have any problem with that. You know what? I'm not embarrassed to say I'm a little crunchy. Um, because I witness it in nature. I can walk outside, I can look out my window, and I can see nature. And I can see nature adheres to certain rules. Those rules actually show up in the market a ton, be it fractalization and Mandelbrot structures, and that's supremely fantastical, awesome, awesome mathematics that I think is just the coolest thing in the world. If you don't know about it, go look up fractals and Mandelbrot structure, and you'll probably find it as cool as I do. But the Fibonacci ratios that we see, they show up in the what we in the pricing, the valuation that we have of things, right? Because it's so natural, and because this market is just an amalgamation of people and ideas, which are natural, right? So by taking those ratios and applying them, and again, in a ratio fashion to the various moves that we see in the market, we can derive significant numbers. They are not buy and sell numbers. They're just numbers of interest that when they start to coincide and they start to overlap with each other, pay attention. These numbers matter. All right. So if I were to take that particular trend up, here we are, a retracement sell down, that gives us now a place where we can extend from. What's the next move likely to take us to? Well, it's likely to take us 69.89, about 7,000, roughly speaking. It might take us all the way up here, but it probably won't land right in the middle. It's going to get towards one of those numbers rather than not. Okay. Well, okay, that's a pretty short-term trend. Let's zoom out. What about the trend that started in late 22, where we finally hit that bottom of the selling in 22? What about that one? Right? What does that show us? Oh, well, if I took that bottom and I come up here to February of 25, right before Trump imposed his validate, what do you call it, Victory Day or America Day or whatever the heck that, where he put tariffs on the world. Okay, we saw the selling there. Okay, what about this trend? Where does that take us? Oh, interesting. Look at that, 7,000, critical number here. We came up, we saw, oh, 55.88 was important, and yes, it was. We went through it, came back down to it, said, yeah, we like this, we're moving on, let's go. We think the market's worth more than that. Keep going. And I say the market, I really shouldn't. We think that this cap weighted index is worth more than that. We come up here, oh, look, where's the next place that the market bumps its head? The next Fibonacci ratio number of this extension. All right, come back down, have a little trouble, come up, get over it, come back down to it, play with it a little bit. Oh, let's move through it. Technically, 50% is not a Fibonacci ratio number, but it is a significant number. We do tend to look at halves. We look at the world in bifurcation, right? So we do lay a 50% line in here because it does matter. And it did to a degree. It really didn't matter nearly as much, though, as the 61.8, because once we broke up through it, we said, we're going to come down and we're going to test it again. And then we're going to go away, but then we're going to come and test it again. And then we're going to make a big push, and oh no, we hit the next number. Guess what happened? We came back down. Okay. So that 7,000 number, two different trends extending forward to a critical number, that matters. Now, you also see down here, this number matters. This is about where our support is. I mentioned that a moment ago. Now, if I lay both of those on top of each other at the same time, you're going to see hard line, hard line. All right, this is where our support region is for the market. We've not sold anywhere near it. Okay, we got a lot of room to go before I'm going to be getting worried about the S&P 500. We're not there. Now, if I want to zoom in, I can tell you another story. I could say, all right, what about just this move from November up to that peak? What about that? Well, in this case, I'm going to use a retracement line. So instead of an extension of a trend, I'm going to say we had this move up. How far down should we go before we can start another leg? Well, we might go down here, 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 or all the way back down. And then from there, we're kind of open season. But in reality, look, it's beautiful. We came down intraday. We got right next to that 61.8 number, pop back up, close the day actually up. Even though we were down from the day before, we closed higher than we opened on the 3rd of March, right? Which is when I recorded the audio piece for you all about just be patient, right? Now, we saw that the next day was great, but it took us right up to this next level, okay, which was a critical number, all right? And then we sold back down. But the idea here is if I just took the closing price, look, we actually closed here, right? That's our high. We've come down and we've tested this 38.2. We're just retesting it a few times. Until we break down through that, I'm not even going to bat an eye about the S&P 500 and the major index strength, okay? But that is levied by large tech. And I could build the case, I could use the NASDAQ 100 and tell you a very similar story. Here's one of the other pieces, though. Again, if I'm going to tell you that I'm building the weight of the evidence, the one piece I did not include is this piece. I mentioned this in the previous video that I did at the start of the year as a forward outlook for 2026. And I said this low, high number is going to come into play. And it just so happens right when it crossed that resistance line, okay, is the day that we did hit the last all-time high of this particular move. So that wasn't a surprise. That was a confirmation. That should have happened. Totally fine. Okay. Now I'm really worried if we get down here to 65.40, 65.50 range, right in here. If we get into that, I'm going to be a little bit more concerned. But right now, orderly selling, completely fine. Okay. I mentioned the NASDAQ 100. Here it is. Okay. In the NASDAQ's case, we've got another great support level, high, low. So this is going off of two different highs, the high in 21 all the way forward to the high in 24 before the tariff selling, the Trump tariff selling, right? And that gave us this blue line, this ascending trend line. Let me move that. Right, this ascending trend line. Look at that. On that day of selling, we came right down to it. And that line also coincides with the Fibonacci extension line of 61.8. We hit that 78.6, came down, bounced off of the 61.8, came back up, went to 78.6, bounced back down. All right, when this, if this breaks down through here, okay, we need to really start aggressively lightening up on our tech exposure and what I would call like our high beta kind of go get them type of positions, the really aggressive stuff. You need to start weaning yourself off. But until then, no, we're fine. We're doing okay. All right. Dow Jones Composite. Okay. Really ugly day yesterday. Now, why was that? Twofold. Dow Jones Composite includes the Dow Jones Industrial Average and the Dow Jones Transportation Average. Now, transport average isn't quite what it used to be. Doesn't mean it's not important. The transports have been rocking. They've been rocking and rolling. The fact that they're having rough days doesn't surprise me because they were cooking a bit, maybe too much. Now, with that being said, let me buzz over here for a minute. I'm gonna really zoom this particular chart out. Okay. If I were to take the April to March, or the excuse me, the March to April of '09 lows, the post GFC lows in the Dow Jones Transport, and I were to go all the way up to right before the COVID anomaly, where we weren't looking at market forces. Granted, a lot of this could be argued the Federal Reserve was way too powerful during this period of time, but we didn't shut down the economy. We didn't tell people you can't go to work. We didn't try to define who was essential and non essential and all the other bogus baloney that these fools did. But if I were to take that market action, that uptrend, and I were to say, okay, that's my normalization line. And then I'm going to say, show me 3 standard deviations off of that mean line, which for statistical reference, 3 standard deviations means it should encompass 99, let's call it for the sake of an argument, 99.9% of all scenarios should fall within 3 standard deviations for statistical normal data. Okay. So using that forward, we can see, well, post COVID, of course, we've got a lot of extra money in circulation because of the inflationary nonsense that they did, printing money and blah 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 blah. But we've broken out both to the upside and to the downside of that previous trend by 3 standard deviations. It's pretty wild. Okay, this is very abnormal for the transport average. Okay, but the fact that it broke so high up, right? It well exceeded the previous breakouts. Okay, the fact that it's selling down, come on, it needs to. Okay, we this thing needs to chill out a little bit, is really what it boils down to. It's just coming back down to earth. But that's not even really the story here. The real story is the industrials, because I focus on the fact the industrials kind of took the leadership role in the major indexes, the Nasdaq 100, the Dow Jones Industrial, and the S&P 500. It was kind of the leading index, kind of as we entered the end of, or rather exited the end of 2025 into 2026, and that was helping us to better understand we are seeing a rotation. We're seeing more money wanting to move away from tech into, let's call it, the real economy, industrials, basic materials. Now, is that because they're afraid? Maybe. Is that because we're just kind of saying like, hey, it's time to get back into reality? Maybe. I'm not out here to tell you why. What I am saying is it was happening. Okay. We're selling back down because, of course, war is going to be volatile for industrial anything. Okay. But that doesn't mean the strength is gone. We're going to use that 47,228 as a nice support level. This was an area of congestion back here in the end of the year. And I think that this is a level that we're going to want to just basically pay attention to going forward. Orderly selling. That's really the moral of the story right now. Now, small caps. Right? Small cap, what a busy chart we've got here. Small caps tell a really fun story though. If I were to use low, low, support level, high, high, once it's broken through, it becomes a new support level. Well, looky there. Those two intersect right where intraday trading has taken us right down to. Didn't even close down here, right? Closing prices didn't get there. It might. Today might be the day. I don't know. But the fact that intraday We're coming down. That's what these tails are. We're coming down to bouncing right off, getting back up. Coming down to getting back up. That's telling me small cap trend very much still intact. If we break down through here, 2492 becomes a very clear area of congestion that should act as another level of support. Break down through that, I'm going to be a little bit more concerned. Okay. If I were to take this over to our long, big picture story chart, disregard the very clear cup and handle pattern, but that's a technical pattern. I'm not here to show you that. What I am here to show you is these purple bars are those regions that I've said the small cap index tends to get stuck in those bands. But once it breaks out, it's going to go one way or the other. It might be like this, where it broke out, failed, and then actually came all the way back down here, tested, went here, right? It, once it breaks out, expect volatility, but also expect it to stay in that range until the next window of time when it's supposed to break out. So here was a breakout. Here was a breakout period, right? We were right before it, and then we broke into the next. We stayed in this region. We broke. Here was the breakdown period. Then we broke up through. We got into the next region. We broke too far, though, came back down. We finished in the next region. Stair step up. Here we are into this territory. Technically, we should finish back here in this territory if this particular pattern holds. I don't know that it will. I really don't think it will. What I care much more about, though, is, yeah, going up, we've got this low line, intraday closing, intraday trading lows. Nope, that one is a closing line. Very good. Okay, here, let's put it on a line chart so it makes it easier to see. All right, so we closed April 25 here. We closed November of 25 here. All right, we've still got some room for this trend to be adhered to. And it very well could stay up in this zone. Okay. But the idea there is the small caps are not breaking down. They are very much adhering to what they should. And in fact, they're probably going to be better off because of their lack of dependency on international business. And they're very nimble, right? That's the beauty of a small cap company is they're much more nimble than their large cap brethren. Trying to be cognizant of time. I'm nearing 20 minutes here, so I'm going to really try to buzz through these. The dollar. I mentioned in the video, the audio piece that I put out earlier this week, the dollar is running, but that's not like a new thing. What matters though is we saw this aggressive pop up. There was a reason that happened. That was the Kevin Warsh announcement. He's going to be the new Fed chair. He's supposedly going to be, super duper hawkish. Okay, sure. But with that being said, that pushed the dollar up because it had fallen way too far. And I think the administration knew that. And I think the administration needed to use a mouthpiece. If you want to know more about my thoughts on that, go watch the video that I put out with the market commentary. That's where that is. But you can see here, this red line came back into play, right? We had broken down through it. That's a long trend line. That's taken us all the way back to 2011, okay? And it's using the 2021 dollar lows to build that trend line. That trend line was violated, okay? So now this trend line looks a lot softer to me, but we're back above it. More importantly, though, we're sitting at the previous highs, January 16th. Now, where I care up here. You get to 100, I'm going to be concerned. But until then, I'm not that concerned. All right. I think that the dollar is going to have some strength here. It'll probably stay above this red line, at least for the foreseeable future, but it's probably not going to exceed the 100 mark, at least for now. If it breaks above that, though, we're going to really reevaluate a lot of things because this could be a real breakaway. Again, it's not probable. The weight of the evidence is not suggesting that's going to happen. So we're going to monitor it. That matters, though, because international. Okay, I'm going to use EFA here, the MSCI, or excuse me, the iShares MSCI EFA ETF. It gives us good pricing to understand, broadly speaking, how the international market's doing. Heavy Japan weighting here. So Japan's very correlated to the US. So it's not necessarily the best representation, but the reality is yeah, international's been rocking. It's been doing great. Did it need to correct? Yeah, it did. Is it correcting a little too much? I think so. But energy is a concern for the broader, let's call it European continent. Excuse me as I just yawned. Um, it's still holding this particular retracement level. That matters. That does act as a significant point for us. What I'm more interested in, though, is as long as we're not seeing major policy shifts, erratic policy shifts, I'm not as concerned about this because fundamentally, under the surface, one of the things that drives, and again, IFA is Japan and it's a lot of Europe. It's not the international market. It's not really giving us a good, clear understanding of the international market. Let's look at some other examples really fast, right? So ILF, Latin America, right? Latin America's rocking too, right? Doing great. Okay. Big heavy selling. There's some gaps in here though that tell me, yeah, if it comes down here and kind of rests around this level, it'll be okay. It can fall down here. Chances are, though, it's gonna be popping back up. All right. If I were to take, let's use what was I gonna grab here? Let's use the emerging markets index, broad emerging market index. Right. This one's been hit a bit harder, and you're gonna see a bunch of different lines here. Let me clear these off for a minute. That's it gets a little bit complex. Right. So here's the uptrend and the retracement. It's actually come down. It's pretty well closed almost right on that level. It's actually a good thing. It's holding. It traded below it, but it's holding it. Okay. This is dollar centric, and this is also small emerging economies are either oil driven or oil dependent. Right now, there's a lot of turmoil in oil, and I can show you what that looks like. But because of that, it's just volatility. It's a lot of uncertainty. What's going to happen? I don't know. All right, here's your crude, light crude futures. Look at that. That's pretty cool, right? Great. Okay, what's the story here? Yeah, oil runs up when there's problems in the Middle East, and boy, are there problems in the Middle East. Um, I'm going to be delicate when I say this. Be very wary of stories about Iran targeting oil refineries in the UAE, in Bahrain, in I'm not going to sit here and pretend to be a geopolitics expert. I am a history nerd. And unfortunately, certain participants in this particular skirmish have a lasting history of intentional friendly fire. And friendly is a loose term because who is a friend? That definition, I'm not here to define it when it comes to these other parties. But there are certain interests that benefit greatly by creating massive disruption for their neighbors. And they have a history of doing this in the past. I'm going to leave it at that. But unfortunately, that lack of transparency creates more problems. Now, most of the cause of this particular run isn't the refineries shutting yet, it's the transportation problems. There aren't a lot of shippers of energy who are comfortable shipping in this environment and going through the Strait of Hormuz. Um, you know, Suez Canal might be in question. It's just one of those. They don't want to be losing ships. They don't want to be losing crew. There's just a lot of volatility. But of course, production facilities are, yes, under attack. By who? I'm not here to say who it is for sure. I'm just saying be very weary of the stories you're hearing about who's immediately guilty. There's probably more to it, but it's creating turmoil in the oil industry, which is affecting the emerging economies. The petrodollar is very much not disappearing, but it's not doing what it used to do. And what that means is the US basically doesn't control the oil markets to the degree that it had by use of its currency. Now, this brings Venezuela back into the picture. Remember that video that I made at the start of the year? The 2026 market outlook. Remember how I talked about the importance of securing resources because things might get a little wacky? Hmm. It's almost like It was all planned out. Yesterday, the Trump administration imported a tremendous amount of gold from, you guessed it, Venezuela. It was a private sector deal, of course. There's no such thing as a private sector deal in Venezuela. But effectively, Maduro's gold hoard that he had accumulated was expatriated. Is that the right word to use? I don't think that's the right word to use. Confiscated? That could be a good word to use. Um, it was brought to the US, just notable. But it was likely known that there was going to be a skirmish in the Middle East. And look, I'm not a tea leaf reader. It's just, I could see the writing on the wall. Securing oil matters, securing shipping matters. Ironically, the Trump administration has promised protection for shippers to ensure. And I'll tell you, the shippers are like, I don't trust a single thing you are saying, dude. You're not trust. You are not someone to be trusted right now. That's not That's not my opinion. That's just what they're saying. So for that reason, the shipping companies, especially in the midstream shippers that are moving the crude and the diesels and the distillates around, there's going to be more volatility for the foreseeable future. It's rocking oil. That's great. I'm glad we own oil. Glad we got into oil. The signals told us to, but it's going to create some calamities. Now, a few final charts here that I want to just quickly blast through. I'm at 26 minutes. Hopefully I can keep this under 30. Um, First and foremost, I talked about gold just a moment ago. Let's look at gold real quick because gold matters a lot to me. Gold tells us a lot. All right. This is gold right now. Okay. This was the day that effectively this was Kevin Warsh was named. He's the hawkish Fed. A hawkish Fed is technically bad for gold because it means the dollar gets stronger. But the idea here is that gold made this big move down that day. Okay, it's been recovering. Was that really gold or was that paper gold that made that big move? It was paper gold. It was not real gold. Gold bullion did not hemorrhage in that day. The demand remains. Silver, very similar story. Look, silver was the real hit, but notice gold has really ascended. Silver is capped. Silver is being capped. Let me be very, very clear about this. This is a horrifically manipulated paper market. It's despicable, in fact, as to what's happening. Um, they won't ever be charged, but the CME Group and the Chicago Mercantile has been doing some of the dirtiest work, probably at the behest of the U.S. government. I hate to say that, China's doing the same thing with their silver paper market, their traded paper market. It's distorting reality, and the fact of the matter is reality is like a rubber band. I don't care how elastic it's. You pull, 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 pull. You could probably keep pulling a little bit further. Eventually, it pops back, and when it does, it pops. That's probably what we're going to see here. They can keep a lid on this thing for a little bit longer, though. So we have some silver exposure. We have miners, right? The miners are set to do pretty well because of this, again, wizardry. I'm going to use the word wizardry because there's another word I want to use, but it's not family friendly. Um, it's repulsive, but it is what it is. We have to navigate the markets that exist, not the markets we want to exist. Um, Copper, not telling us a lot. Really not a lot going on, and that's to be expected. No secrets, no surprises there. Up here, real fast, I'm going to bring up the value line geometric index. This is the average stock. I talked about this in the last video. This basically says what was the average stock doing? The average stock's not rocket shotting all the way to, the moon like S&P or these indexes. This is basically taking a geometric weighted average of the entire stock universe so that we can see like what the average stock's doing. It's kind of like, you know, the wealth of the nation. The top 1%'s wealth has gone astronomical over the course of the past 5 to 7 years. The average person's wealth has eh, eh, kind of getting there. We're trying. Okay. This is the same story. because we're getting wealth concentration problems. We're getting, some would say, end of empire problems. I'm not going to sit there and say that because, look, yeah, it happens. But it also happens when stuff gets manipulated by a bunch of concentrated power holders. That's the problem with big governments. But here we are, the average stock not doing so hot, but the reality is it's also not selling that much. It's had a nice big run. And if I were to take, for example, that's not what I wanted. Let me grab the wrong chart there. Bear with me here. Let's get our moving averages. Okay. And then let's go back to this. All right. Here's the same value line geometric index. A lot of different moving averages. We've got 200-day exponential moving averages. We've got 5-day simples. We've got 150-day simples. We've got 200-day crosses. Don't worry about all that. What I want you to look at is down here. Okay. This is the trend, basically. It's the slope of the 150-day moving average. As long as it's positive, as long as it's still sloping up, that means the average stock is still going in an uptrend. Okay. It still is. That's a good thing. Just confirmation, just building that same story that we've been talking about the whole time. Orderly selling. It's not time to get worried yet. It's time to just simply accept the fact that, yeah, the portfolio is getting smacked. It is what it is. But the portfolio was also dramatically outperforming coming into this. That's okay. Nothing has changed. Nothing has changed. Let's look at consumer sentiment for a minute. And let's just see, this is consumer discretionary to consumer staples. Notice this big hard turnover here, right? That kind of peaked out October of, of 25. And it's really been steadily declining. It kind of retested, but it broke down through this region, this gray area, came all the way down, but it's still holding its uptrend. The thing that I think is most interesting, though, is look at the past couple days, right? This was trending down going into the conflict. The consumer is all of a sudden looking really strong in America. That bodes really well for the small caps. That bodes really well for consumer driven stuff. It's not getting smacked around. Now, pre market, we'll see what happens when it actually opens. But pre market, yeah, it's given back yesterday, but that's not something that you would expect in the current case. But it is what it is, right? Consumer um, staples are making a big a push compared, excuse me, consumer discretionary is making a push compared to consumer staples. So people aren't, the market's not flooding to safety yet. It's not there. VIX. Here's a great one that I want to just quickly showcase. I could tell you my thesis. All right, okay, I will. I'm gonna revisit my thesis on the VIX because it's important to recognize this. Okay, we have a lot happening on this chart. The thing I want you to notice is there are 3 different colored arches here. Those are time frames. Okay, purple is 60-month, red is 96-month, and the blue or the turquoise is 54-month. We go through repeating patterns of these branded periods, right? Where we go 60, 96, 54, 60, 96, 54, 6, and alternating. We have low volatility periods, high volatility periods. So that's the green and yellow boxes. You're going to see the volatility index lives much higher in these alternating periods, but the length of those is on a whole different scale. It's on a 3 measure, whereas the high low is on a 2 measure. If I'm probably abusing music, I'm not a musician, but think of it that way. So low, high volatility, low volatility, high volatility, low volatility, and we can see this pattern repeats. It's pretty amazing. It really is. We are technically in a low volatility cycle. We've had a lot of high spikes, but the average has stayed about 20 or below versus, again, look at this last period, right? Look at that. That was much higher. It keeps creeping up though. It keeps wanting to creep up. So even though we're in a low, we've got a new period coming in 2028. September of 28 is right now, like if I had to put a mark on the calendar where things are going to get ugly, that's when it should. But we're way away from that, and I'm not here to say that. What I am here to say is it keeps creeping up. However, let's look at this not on intraday. Let's just look at it here. Oh, I'm on week. Oops. Let's get back to daily. There we go. All right, now we're talking. So notice here we were in this last period, this higher volatility period. We don't have the yellow box anymore, but this was a high volatility period, right? Here was the highest high of that period minus the 2020 hiccup, right? We had high, but we had a lower high. We were trending into a lower period. But notice we broke through two times. One of those was in August of 24, and the other one was in April of 25 with tariffs. So non-natural, right? These were imposed by kind of a thumb on the scale moment, but we've been pretty well adhering to this line. Now today we've spiked up. Okay. Here's, come on, get zoomed in there for us. There we go. All right. Today we're coming right back up, but we're retesting the intraday highs of Tuesday. Chances are we might actually settle back down below this line. And if that's the case, this will not be way up here. This will be back down here. We've got a nice downtrend. Now it's a converging, right? We've got a higher bottoms. We've got lower tops. Okay. We're probably going to see a breakout, but the volatility seems to be cooling. It's going to be high this morning. Let's see what happens. Right. Market's actually just about to open. The last one that I'm going to bring up here is the lending space. I did not mention in the audio piece, and I want to make this a very clear statement here. There is a story you're not getting a lot of news about at all. Um, I made a video last year at the end of the year. Go back and watch it if you're interested, about the private equity, private credit industry. Trump was talking about wanting to put it into 401ks, qualified plans. I explained why the private credit industry was an absolute disaster waiting to happen. That disaster is kind of happening right now. I had said the reason he wanted to put in the 401k is he was basically trying to protect friends' interests. And he has friends that have interests in this. And they were lobbying him and saying, hey, friend, I need you to do this for me. And he's like, bear with, the market just opened, so I'm going to start getting a lot of alerts. Private credit is having a problem right now. But because of that, it's causing the lending space. So that's bonds. That's the whole bond industry. But bonds are getting stressed, not because of the Fed, but because of what has happened under the surface. There's a lot of carry on and knock on effect of private credit and what's happened. But because of that, we need to be very cautious of watching what I call, basically, not I call them, so the industry calls high yield spreads. So it's basically how much more appealing the risky lending is compared to the not risky lending. So if you can make a whole lot more money lending to somebody risky, great. The problem though is how risky are they? If they're not really that risky and I can make more money doing it, they're just qualified as risky. Great, I want to do it. But as things start to get uglier, I don't want to lend to them because they really are risky now. Okay. That's what this particular chart is showing us. This is showing us kind of the high yield spreads. So we're using HYG, which is a high yield ETF, and we're using IEI, which is a kind of a medium duration ish, 5 to 7 year, 7 to 10 year. It fluctuates a little bit, but let's just call it a 5 to 10 year treasury bond. Okay, do I want to lend my money to the U.S. government, which is losing credibility in and of itself? So this, parameter is only so good. But the reality is yes, since late January, the lending market has been tightening. That's the private credit market that's creating that stress. Okay. That's the lack of faith in the dollar that's creating that stress. That's a lot of factors. It has nothing to do with Iran. However, it is happening right now. Blue Owl, if you want to look up some news stories, go read them. You're not going to get a lot of really good coverage. It's really clear, but you can get the gist of the story. You can see Blackstone, or it was actually BlackRock, I think, closed one of theirs, but I think Blackstone's also looking at closing one of their private funds. That's the problem with these things. They're not marketed. So because of that, though, you're getting not a credit collapse, but you're definitely getting credit stress. When you have credit stress, you have everything else stress. Just the bond market is it's like water in a house, right? When you don't have water, a lot of other things start really breaking down. Okay. Your grass starts to go dry if it's the summer. Your toilets don't flush. Things start to get stinky. You can't wash your hands. You can't boil water, right? You can't. The bond market, the lending market, the credit market. That's why I said in my video at the start of the year, 2026 outlook, you're not going to see people going to bonds for safety. They're going elsewhere, and we will too. So 40 minutes. Okay, capping it. We're done. We did it all. Here's the thing, if this comes down below this line, this key level of interest, I'm going to be more concerned. But right now, we're holding in there. So let's wait and see what happens. In the meantime, have a wonderful weekend. If you have questions, let me know. Don't stress about this. The stories, the news, the reality is so much of this is out of our control. What is in our control is what we can do. We're going to do it portfolio wise, plan wise. If you have concerns about your job, if you're one of my military families, you have any questions, you want to talk about things, please give me a call. Otherwise, have a great week.